In a dramatic turn within Hollywood's rapidly evolving media landscape, Warner Bros. Discovery has reportedly rejected a preliminary takeover approach from Paramount Global, according to a Bloomberg News report. The proposal, which could have reshaped the U.S. entertainment industry, underscores the deep financial and strategic tensions driving major studios as they struggle to adapt to the shifting dynamics of streaming, advertising, and theatrical distribution. The proposal and the rejection. According to sources cited by Bloomberg, Paramount Global, the parent company of CBS, MTV, Nickelodeon, and Paramount Pictures, informally reached out to Warner Bros. Discovery (WBD) earlier this quarter with an exploratory proposal to discuss a potential merger or acquisition. However, Warner Bros. Discovery CEO David Zaslav and the board were reportedly unimpressed by the approach, viewing the deal as strategically misaligned and financially premature. Insiders familiar with the matter said that WBD, still managing its own massive post-merger debt load following the 2022 combination of Warner Media and Discovery, was not in a position to pursue another large-scale merger. Hollywood's consolidation pressure. The attempted approach highlights the growing pressure among legacy studios to consolidate in the face of streaming competition from tech giants like Netflix, Amazon, and Apple. Both Warner Bros. Discovery and Paramount have been grappling with heavy debt burdens, declining cable revenues, and the challenge of making their streaming platforms, Max and Paramount Plus, profitable. Industry analysts say that while mergers among traditional studios might create scale, they also risk compounding debt and regulatory scrutiny, particularly under the Biden administration's tighter antitrust lens. Financial realities behind the curtain. Warner Bros. Discovery carries over $40 billion in debt, a legacy of its 2022 merger, while Paramount Global's debt stands at roughly $15 billion. Paramount's controlling shareholder, National Amusements, led by Sherry Redstone, has reportedly been exploring options for a strategic partner or potential sale amid falling stock prices and investor pressure. The company's market value has dropped nearly 80% over the past 5 years, while Warner Bros. Discovery's shares have also fallen sharply in 2024 due to weak advertising markets and underperforming theatrical releases. Streaming wars. A costly battle. The streaming sector, once seen as Hollywood's golden future, has turned into a profitability nightmare. Paramount Plus continues to post operating losses, while Warner's Max is striving to retain subscribers amid fierce competition. Both companies have attempted to cut costs by canceling projects, laying off staff, and restructuring content budgets, but the results have been mixed. Analysts suggest that consolidation could help share content libraries, reduce marketing expenses, and strengthen negotiating power with advertisers, but only if executed without adding to financial instability. Analyst reactions and industry outlook. Wall Street's reaction to the news was muted but cautious. Analysts from MoffettNathanson noted that while the idea of a Paramount-Warner merger might sound thematically logical, it is financially untenable given both firms' balance sheets. Some analysts also warned that such a merger could trigger antitrust concerns, particularly in television distribution and sports broadcasting, where the companies already control major assets such as CNN, TNT, CBS, and the NFL rights. For now, the rejection signals Warner Bros. Discovery's intention to stay independent and focus on stabilizing operations rather than pursuing headline-grabbing mergers. What's next for Paramount and Warner Bros.? Industry observers say that Paramount may continue to seek partners or potential buyers, possibly in the tech sector. Companies like Amazon or Apple could find strategic value in Paramount's content library and sports assets, though such moves remain speculative. Meanwhile, Warner Bros. Discovery is reportedly focused on boosting its Max platform, monetizing its extensive franchises, including DC, Harry Potter, and Game of Thrones, and improving cash flow to service debt. A symbol of Hollywood's new reality. The failed approach reflects the broader turmoil in Hollywood, where the streaming boom's aftermath is forcing studios to rethink growth strategies. Once mighty entertainment conglomerates now find themselves squeezed by rising production costs, audience fragmentation, and investor impatience. As one analyst put it, Hollywood's biggest drama is no longer on screen, it's in the boardroom.